Central banks in Poland just bought more gold in one quarter than they did in the previous decade. China's official reserves show modest gold purchases, but their actual imports 4 times higher than what they're reporting. And here's my favorite part. The asset that's supposed to be a hedge against chaos is rallying at the same time the stock market is partying like we just cured inflation and solved world peace. So either gold knows something we don't, or we're all watching the world's slowest institutional bank run in real time. Gold just hit another all-time high. Again. And then it did it again the next week. And the week after that. For the last 18 months, this has been happening so consistently that traders have basically given up trying to explain why. I spent the last month reading central bank reports that would bore a CPA to tears. I've looked at gold flow data, reserve diversification patterns, and enough IMF documents to question my life choices. And I'm going to walk you through exactly what's happening, why almost nobody saw it coming, and what it means for your money. Because this isn't about some conspiracy theory or the dollar collapsing tomorrow. This is about incentives, game theory, and what happens when the world's biggest players start quietly hedging against a future they don't trust. Think of the global financial system like a game of musical chairs. For 80 years, the US dollar has been the only chair anyone wanted. Every country needed dollars to buy oil, to settle trade, to park their reserves. It was the safest seat in the house. But here's the thing about musical chairs. The game works fine as long as everyone believes there will always be enough chairs. The second someone starts to doubt that, the whole room gets nervous. And that's when people start looking for a chair that can't be taken away. That chair is gold. Now, if you've been paying attention to financial media over the last few years, you've heard about a dozen explanations for why gold is ripping. Inflation, geopolitical tension, central bank buying, weakness in the dollar. And sure, all of those things are true, but they're symptoms, not causes. Because here's what most people miss. Gold doesn't move because of what's happening right now. Gold moves because of what institutions think is going to happen 5 or 10 years from now. And right now, the world's largest financial institutions are positioning like they're preparing for a future that looks very different from the past 80 years. Let me show you what I mean with some numbers that should make you uncomfortable. In 2001, central banks around the world held about 66% of their foreign exchange reserves in US dollars. That number made sense. The US had the most liquid markets, the strongest rule of law, and the global reserve currency. Fast forward to today, that number is 58%. Now, you might think an 8-point drop over 25 years doesn't sound that dramatic, but we're talking about trillions of dollars in aggregate reserves. An 8% shift represents the largest sustained move away from dollar dominance since the Bretton Woods system was established. And it's accelerating. In 2022, central banks bought just over 1,000 metric tons of gold. In 2023, they bought 1,000 and also another 40 metric tons. In 2024, they bought 1,184 metric tons. That's the highest annual purchase in recorded history. And this isn't some niche trend. According to the World Gold Council's survey, 41% of central banks plan to increase their gold holdings in the next 12 months. Only 1% plan to reduce them. Those are not the numbers of a stable system. Those are the numbers of institutions running a fire drill. But now you might be thinking, okay, central banks are buying gold. So what? They've always held gold. That's normal. And you'd be half right. Central banks have held gold for decades, but the composition of who is buying and why they're buying has completely changed. Because this isn't the Federal Reserve or the European Central Bank stocking up. This is Poland, Singapore, China, India, Turkey, and a bunch of countries you wouldn't expect. These are nations that have spent the last 2 decades integrating into the dollar-based financial system, and now they're quietly backing away from it. Here's a story that illustrates this perfectly. In 2022, the United States and European Union froze roughly $300 billion of Russian central bank reserves after the invasion of Ukraine. Now, to be clear, I'm not making a political argument about whether that was right or wrong, but from a pure game theory perspective, every other country on Earth watched that happen and learned a very important lesson. Foreign reserves held in another country's system can be frozen or seized. If that country decides you're the bad guy, it doesn't matter if you agree with the decision. What matters is that it's possible. And once something becomes possible, every rational actor has to plan for it. China holds over $3 trillion in foreign reserves. A huge chunk of that is in U.S. treasuries. Do you think Chinese policymakers watched Russia get cut off from the global financial system and thought, well, that could never happen to us? Or do you think they quietly started asking their economists, what's the one asset we can hold that the US can't freeze, sanction, or take away? The answer is gold. Because gold, sitting in a vault in Beijing, is outside the reach of any foreign government. It's the ultimate non-counterparty asset. And that's why China has been buying it hand over fist. Now, here's where it gets really interesting. China's official gold reserves, according to their central bank, increased by about 225 metric tons in 2023. But if you look at the actual physical gold imports into China through Hong Kong and Shanghai, the number is closer to 900 metric tons. That's a 400% gap between what they're reporting and what they're actually buying. They're not even trying to hide it anymore. They're just not advertising it. Because the last thing China wants is to spook the market or signal to the world that they're preparing for a post-dollar system. But the data doesn't lie, and it's not just China. India's central bank added 37 metric tons in just the first quarter of 2026. Poland bought 109 metric tons last year, more than they bought in the previous 20 years combined. Turkey has been buying gold so aggressively that it now makes up over 30% of their total reserves, up from almost nothing a decade ago. This is a global trend, and the common thread is simple. These are countries that don't fully trust the long-term stability of the dollar system, but they also can't say that out loud without causing a diplomatic incident. So instead, they're doing what smart institutions always do. They're hedging. Not loudly, not dramatically, just persistently, month after month, quarter after quarter, buying gold and quietly reducing their dollar exposure. And the wild part? Most people have no idea this is happening because it's not showing up in headlines. It's showing up in boring central bank balance sheet updates that nobody reads except people like me who clearly need better hobbies. But let me address the obvious question you're probably asking yourself. If all of this is true, why is the stock market also at all-time highs? Because historically, gold and stocks don't both rip at the same time. When investors are feeling good about growth, they buy stocks and real estate. When they're scared, they buy gold and bonds. Risk on or risk off. You pick a lane. But right now, both lanes are packed. The S&P is near record levels. Nvidia is valued like it's going to replace half the global workforce by 2028. And at the same time, gold is also hitting records. So what's going on? Here's my read. We're living in a bifurcated market. Retail investors and a lot of institutional money are still pricing in the everything is fine narrative. AI is going to boost productivity. The Fed is going to engineer a soft landing. Inflation is cooling. Growth is solid. And if you only look at US domestic data, that story holds up pretty well. But at the same time, the world's central banks, sovereign wealth funds, and long-term institutional players are pricing in a very different future. They're looking at US debt to GDP ratios north of 120%. They're watching the political system become more unstable. They're seeing the weaponization of the financial system, and they're thinking, maybe we should have a plan B. So you get this strange phenomenon where short-term sentiment is bullish, but long-term positioning is defensive. It's like watching someone buy a vacation home while also quietly stockpiling canned goods in their basement. Both behaviors are rational if you believe the present is good, but the future is uncertain. And that's exactly what the data shows. Record stock buybacks, record gold purchases, record government debt issuance, record everything. It's not a contradiction. It's a reflection of deep, unresolved uncertainty about where we're headed. And this is where most people get tripped up. They assume markets are efficient and that all assets should tell the same story. But markets aren't efficient in real time. They're efficient over long periods after all the information has been processed and repriced. Right now, we're in the messy middle. Different players have different time horizons, different information, and different incentives. Retail investors are trading on quarterly earnings and Fed comments. Central banks are positioning for the next 10 to 20 years. And gold is the place where those two timelines collide. Let me give you a concrete example to make this more real. Let's say you're the head of a mid-sized central bank. Your country runs a trade surplus. You've accumulated about $50 billion in foreign reserves. Historically, you've kept 80% of that in US treasuries because they're liquid, safe, and yield a return. But after watching what happened to Russia, you're nervous. You don't think your country is going to get sanctioned tomorrow, but you also didn't think Russia was going to get locked out of SWIFT. So you start running scenarios. Scenario 1, everything stays the same. The dollar remains the global reserve currency. U.S. Treasuries stay safe. You keep your 80-20 split and collect your 2 to 3% yield. Scenario 2, over the next decade, the U.S. becomes more fiscally reckless, more politically unstable, or more willing to use the financial system as a weapon. In that scenario, having 80% of your reserves in dollar assets is a catastrophic risk. So you start shifting, not all at once, just a few percentage points a year. You buy some gold, maybe some euros. Maybe you even start exploring digital settlement systems with your trade partners. And you do it quietly, because if everyone does this at the same time, it becomes a self-fulfilling crisis. That's the game being played right now. And it's not a conspiracy. It's just rational risk management by institutions that have a longer time horizon than the average investor. And the crazy part is, even a small shift in behavior by these players has a massive impact on the gold market, because the gold market is tiny compared to other asset classes. The total value of all the gold ever mined is around $15 trillion. That sounds like a lot until you compare it to global equities, which are worth over 100 trillion, or global real estate, which is over 300 trillion. So when a central bank decides to shift even 2 or 3% of their reserves into gold, it moves the market in a big way. And that brings me to the part that almost nobody is talking about. Gold supply is basically fixed. Global gold mine production is about 3,500 metric tons per year, and that number hasn't grown much in the last decade. In fact, ore grades are declining, meaning it's getting harder and more expensive to pull gold out of the ground. Meanwhile, demand from central banks alone was over 1,000 metric tons last year. Add in jewelry demand from India and China, technology use, and investment demand, and you're looking at a market where supply and demand are very finely balanced. Any sustained increase in institutional buying pushes prices higher. And unlike stocks, you can't just issue more gold. So what does this all mean for you? Because I'm not here to tell you to panic or to dump your portfolio and buy gold bars. But I do think there are 3 very practical takeaways that matter if you're trying to build wealth in a world where the rules might be changing. First, understand that portfolio diversification isn't just about stocks and bonds anymore. For the last 40 years, the classic 60-40 portfolio worked because stocks and bonds were negatively correlated. When stocks went down, bonds went up, and vice versa. But that relationship broke in 2022 when both stocks and bonds got hammered at the same time. The old playbook doesn't work as well when inflation is back on the table and central banks are trapped between supporting growth and controlling prices. Gold, whether you hold it physically through an ETF or via mining stocks, is one of the few assets that doesn't have counterparty risk and isn't tied to the performance of the financial system. I'm not saying it should be 50% of your portfolio, but 0% might not make sense either. Second, pay attention to what the big players are doing, not what they're saying. Central banks are not in the business of making bold public statements about losing faith in the dollar. They'll never say that out loud, but their actions tell you everything you need to know. If the institutions that have the most to lose are quietly diversifying away from dollar assets, that's a signal. It doesn't mean the dollar is going to collapse next year, but it does mean the people with the best information and the longest time horizons are hedging. And if they're hedging, you should at least be thinking about it. Third, recognize that we're in a transition period, and transition periods are messy. The global financial system is not going to flip from dollar dominance to something else overnight. It's going to be a slow, grinding shift that plays out over decades. But shifts like this create opportunities for people who see them coming and risks for people who don't. The investors who do well in the next 10 years won't be the ones who predict the future perfectly. They'll be the ones who build resilient portfolios that can handle multiple possible futures. And part of that resilience is holding assets that do well when trust in the system declines. So here's where we land. Gold isn't rallying because of inflation or because of some short-term geopolitical event. It's rallying because the incentives that held the global financial system together for the last 80 years are starting to shift. Central banks are losing faith, not in a panicked way, but in a slow, methodical, let's have a plan B kind of way. And when the world's biggest and most sophisticated institutions start quietly hedging against the future, the price of the hedge goes up. That's what you're seeing in the gold market. Not speculation, not hysteria, just game theory playing out in real time. The dollar isn't going away. The US is still the largest economy in the world with the deepest capital markets. But the era of unquestioned dollar dominance is ending. And gold, for all its flaws, is the asset that benefits when trust in the system becomes conditional instead of absolute. You don't have to become a gold bug. You don't have to buy into the doom and gloom narrative, but you should at least understand what's happening and why. Because the institutions that manage trillions of dollars already do, and they're positioning accordingly. The people who built wealth over the last century weren't the ones chasing hype or trying to time the market perfectly. They were the ones who understood incentives, recognized structural shifts, and built portfolios that could survive change. Lazy investing built more fortune than crypto memes. And right now, one of the biggest structural shifts in the global financial system is happening in slow motion. Gold is just the symptom. The cause is a world that's quietly losing faith in the old rules and hasn't agreed on the new ones yet. And that's a world where having some insurance makes a lot of sense.